This is Chip Maxwell, and you're listening to the Retire Smart podcast with David Brooks. In our discussion today, we break down the shifting real estate landscape, from softening home prices in Florida, Texas, and beyond, to a surge in rental supply that's driving rents down nationwide. We explore why new construction is suddenly cheaper than existing homes, and how builders are responding with incentives, and what Warren Buffett's latest bets on home builders might signal. Plus, we conclude with insights on market valuations, portfolio risk, and the surprising global migration of millionaires. David, we have talked several times recently about the softening of the real estate market in Florida and in Texas, but you sent the team some information about how this is starting to spread nationwide.
Yeah, so we talked about real estate. You know, the commercial has been in the pain for the last 2 or so years. This year, we talked about residential real estate would start to fade, and it is, especially in the markets where it was really frothy, Florida, Texas, Arizona, where people were migrating during the great COVID migration from big, heavy tax states. They decided to migrate to states that were a little friendlier on freedoms and taxation both. And so what we've got up now for those of you watching on YouTube is a chart just showing you the price changes basically year over year and month over month in over 30 cities here. And so it's starting to get severe, right? And so, again, I talk about all the time. I walk my dog every morning, and there's like 4 listings now on this couple of streets where I live. One of them has been on, the person purchased this home 2 years ago for $599,000, and it's listed for sale today for $625,000. It was like $675,000 6 months ago. Person has moved out of state. It's sitting there, and I kind of walk by. He should probably cut the grass if he wants to sell it. I'm like, it's starting to look, and that's the problem. Is properties sit on the market, people spend less money to keep them up. They start to lose their motivation. They get upset, and so they're mispriced, right? And so sadly, the person's probably thinking, "There's no way I should sell this property for less than I paid for it 2 years ago." Well, that's the reality. If you want to move your property, you may have to take a severe cut. But here's the thing: people don't think the problem through. If that person has a mortgage on said property, call it $2,500 a month, and they hang on to the property for another year, how much is that, Chip? That's $30,000, right? So if they just cut the price $25,000 and sold it today, they end up with more money than if they carried it for another year and got their asking price. So in other words, people need to start doing the math, and you're going to see some people that just run out of the capital to carry that second mortgage on a house. And we're also seeing the phenomenon of Airbnbs, right? So on the show today, we had our buddy Mr. Wooten from Texas. Well, Texas is inundated with Airbnbs in certain marketplaces that are popping on the market outside of Dallas-Fort Worth area. The amount of listings that are popping up is insane. And so there's over 550,000 more listings today than you have people searching as buyers according to Realtor.com. That's a pretty big shift.
Meanwhile, you also sent the team information that rent prices are dropping aggressively. I guess that's good news for tenants, but not necessarily for the economy.
Well, so you're having, we had a massive build in multifamily, and those are coming on. And if you just look here, if you just drive out west, go out on 204, right? All the apartments you see out there, there's some new movie theaters and things, but those apartments are coming on faster, just out on West Dodge here. And they're coming on so fast that now they all have signs up where just 3 years ago, they would only have 1 or 2 available a month occupancy. Now there's apartments available everywhere. So the price cuts are starting to happen. I have an adult child who's looking, and they're much cheaper today than they were a year ago. $300-400 a month cheaper in some cases for a 2-bedroom apartment right here in Omaha. And in Florida, it's the same phenomenon. I have a 29-year-old that lives down there that's looking at some different space. And so we are seeing rents drop. This is a good thing for those that are affording, but there's never been such a gap between renting and owning, Chip. It is so much cheaper to rent today than own. And frankly, I wish I was renting my home. I've talked about it many times. It's just a house I live in, right? But my wife mandated that I own the home. When we went through, she mandated that I pay off a mortgage. It was only at 2%. I didn't want to do it. But anyway, happy wife, happy life, folks. But anyway, so I could rent a house like mine cheaper than it cost. My house is paid for, Chip. Cheaper than my property taxes, homeowners insurance, and maintenance upkeep on my house. I can rent a similar house here in Omaha. So why do I own the house? I could have that $600,000 plus working for me in another investment. So you need to do your homework if you're trying to buy a house. But the good news is the real estate market is starting to show signs of fading. And so if you are a first-time home buyer, it's going to get better. We got another chart to show you the gap between new purchases.
This one I could not get my head wrapped around.
Okay, so traditionally, when you buy a brand new home, you're going to pay 5 to 7% more than if you bought an existing home in a nearby neighborhood.
That
right?
makes sense to me.
Because you're getting brand new warranty on the house, the appliances are day one, et cetera. Where if you bought somebody's house that was 8 years old, 2 streets away, it's got, some maintenance you might have to do, et cetera. So historically speaking, you always pay 5 to 7% more for a brand new home. That's not the case today, right? So new houses are now, for the first time in history, Chip, nationwide cheaper than the average listing of the median home prices in most cities in America. So you can go. So that is a really big shot across the bow for those of you that have your house listed for sale. You're going to have to aggressively knock your price down if you really want to sell it in the next couple of months. Because why would you buy their house? And that's people are struggle to understand the market valuation. And I talk about it like
builders must be getting killed then.
But see,
builders
here's the
of
thing.
new homes.
Builders have already spent the money, Chip. So they have the house sitting there. When they built a spec home, if they've got $500,000 in this house, how do they get the cash out of that house? They sell it. Even if they cut the price $50,000 to move it and take a loss, it's better for them to have the $450,000 that they can go to work and do something with than have a $500,000 dead asset on their balance sheet. So builders are going to get very aggressive with incentives, closing costs, new upgrades, and you as the seller of just your single family home probably are not in the financial shape to be able to do that. So I literally had this discussion with a client last night. Basically, new relationship, him and his significant other just bought a house together, and they have 2 houses they're trying to sell. And he goes, what do I do? I said, price them right, or hang on to them and rent them for the next 3 years. We're going to get through a bumpy real estate market. It's coming.
Okay, despite all these indicators we've gone through here, you also alerted the team to the fact that now we finally arrive at the Oracle of Omaha, Uncle Warren. Buffett has added some major home builders to his portfolio. What is going on here? Yeah,
so I believe he added DHI or DR Horton is the largest builder in America right now, and Lennar Homes in his latest quarterly filing. So he discloses what he does. He sold some Apple, give you an idea. So he sold off some more Apple, sold some Bank of America and some other things in there, and all this is public disclosure. But he made major purchases in these home builders. Now, that is a bet, in my opinion, of a aggressive rate cuts coming from the Federal Reserve, because those builders, if the rates get cut, just so you understand, most of these builders, when you buy, and we talk about the incentives to get said incentives, it's usually tied to you have to use their mortgage company. So they make a spread on the mortgage as well. If rates go down, their spread widens and it makes them profitable. So their lending arms of these companies, those divisions, can become much more profitable. That's been not only unprofitable, but just downright losing money for the last 3 to 5 years in the mortgage industry. So those are going to swing back, and that's why he's making, and again, Buffett is smart and makes long-term value purchases. He's not doing this because, Chip, the home builders are going to skyrocket 20% between now and the end of the year. I don't believe that's the motive. I believe he's betting on the long haul, and they'll probably be adding to this position. Remember, they only disclose their positions to us once per quarter.
David, you mentioned in the third segment price-to-book ratio, and you sent the team several charts on price-to-book ratio, standard, the S&P 500, price-to-book ratio, price-to-earnings. Sort through that for us. You folks on YouTube, you'll have several charts passing before your eyes. For the folks on radio, to the degree you can, use words to describe what's happening.
So the first one we have up is what we call price-to-book ratio. So price to book, if we sold a company, not for its intangible, right, not for its goodwill and its branding, its assets. Like if we were selling Retire Smart, it would be the camera that we're looking into, the microphone. These are our assets, right? Our desks, our furniture. These are things that are tangible that can be sold, right? So when you sell a company for book value, right, that's just the hard assets selling without a lot of future growth. You're not paying for any future growth of the company's revenue or earnings generation. So it typically doesn't sell for book value, but you can calculate the ratio of what their book value is based on their quarterly financials. Well, we are now above the highest in history price to book ratio. So it's just another metric of valuation, like we talked about with the questioner earlier, one way to price the market. So what we're looking at now is a PE ratio chart. So that's price to earnings. That's a very simple formula, Chip. If a company's stock is $10, Chip, and they earn $10 a year, right, in earnings, what's their price to earnings ratio? It'd be 10 to 1. You follow me?
Right.
If $100 a share and they earn $10, they're earning 10 times, right? So the price of their share is 10 times their earnings. That's a 10 to 1 PE ratio. Historically speaking, the S&P trades around 17 times earnings of all its companies combined. Well, we're over 22 times earnings right now. But when you look at the valuation, how stretched it is, the bulk of the companies are over 30 times earnings, right? And that's another way of saying the market may be getting ahead of itself. Are earnings going to grow fast enough to keep up to warrant this valuation? And that's perfectly normal. So sometimes the market doesn't have to always correct, Chip. Sometimes the market will do what we call base, and it'll just chop along for 3 to 5 months sideways until the earnings actually catch up to give it that valuation. But what I found interesting is how many companies there have a PE ratio less than 10. Out of all 500, the number is 1, Chip. There was one stock on that chart on the far left of it. Only one company. Now that makes me nervous. All 500 companies are not going gangbusters the exact same time. For instance, on Tuesday of this week, Chip, we had a down day in the markets, right? About 1% down day in the markets across the board, but over 65% of the companies had a positive day. So again, people get skewed by certain pieces of the news and the metrics. You need to understand how to value your portfolio properly. The lesson here is make sure you understand the amount of risk you're taking, what is your portfolio valued at, and what volatility can you expect going forward. And if you don't know how to do that, we have some tools we can complimentary do for you and show you what the volatility of your portfolio is.
David, in the final segment here of the show, final minutes of the show, some economics 101. Global millionaire migration. You sent the team some data showing that actually the United States is doing well. We've got people coming here. The UK is getting creamed. Give us some details.
Yeah, so this is millionaire migration across the globe in just this year, in 2025. And United Emirates, right, in the Middle East is the major benefactor. And that's because people from the Far East, from Russia, from Europe, from the U.S., et cetera, are migrating there because they are open for business, Chip. Deregulation, very low taxation, and therefore they are attracting capital and millionaires to live there, which benefits their economy. Now, number 2 on this list is the United States. And that's one of the things Trump is trying to do, is to reshore the global elite to want to set up domiciles here because we benefit from their investments, right? And that's part of the big, beautiful bill, was to reduce tax liability on people so they come here. And wealthy people do not sit on their cash, right? And so people always argue, oh, that Elon Musk has too much money. And I'm like, well, he doesn't really have money. It's value in all these companies he's formed, and he owns stock. And if he sold all that stock, right, and it turned it into cash, then he'd have money. But he doesn't, and he doesn't want to do that because he believes in the future value of those equities and those things that he owns. So again, people just don't understand how capitalism really works. We need to get back to teaching that in school. That would be nice. But anyway,
financial literacy.
You're seeing, company or countries suffer that are over regulatory, over taxation, and continue to push that way. And the UK is the prime example we are seeing, and people are leaving there in droves. France went through this a few years ago. If you remember, they put in a 75% wealth tax, and everybody fled. And they're like, oh, we were just kidding. I'm sorry. We can't do that. So again, the money flows where the regulation lets it go, right?
Thank you for listening to the Retire Smart podcast with David Brooks. If you want to learn how to generate lifetime income, reduce your tax bill, and maintain your lifestyle in retirement, visit retiresmartpodcast.com. And make sure to subscribe to keep up with new episodes every week.